Good evening, everyone. Welcome to IMA's Doha Chapter's event under the topic, The Shortcomings of Financial Reporting. Let me take you through some introduction about the IMA. Most of you know what is IMA and what is Doha Chapter, but just to recap, the Institute of Management Accountants is the worldwide association of accountants and financial professionals in business. IMA Global was founded in 1919 in the USA, and currently they have more than 125,000 members, and they are spread around in 150 countries, and they are served by more than 300 chapters. Since inception, more than 70,000 CMA certificates has been awarded. IMA Doha Chapter is one of the chapters serving the members, and it was founded in 2009, and last year in September it was registered under QFC, Qatar Financial Center. Currently we have more than 550 members in Doha, and annually 30 to 40 CMA certificates are being awarded. During the past, we have achieved lots of accolades and positions in the competition with IMA other chapters. In 2017, we were the first in the world. And in 2018, we were the 4th place in Stevenson Division chapter standing. And we also received many awards for the newsletters and social media performance. We provided more than 12 seminars and 3 webinars in 2018 with a total number of CPEs of 35. And total number of attendees were around 974. In September, one of our success stories was the IMA Doha conference. This was the first conference in Doha conducted by IMA Doha Chapter, and it was conducted over 2 days on 14 and 15 September. The conference provided lots of seminars and educational modules by more than 16 presenters, and it was attended by more than 120 finance professionals or accountants from Qatar and from other countries as well. We have many websites, and you can follow us on social medias like LinkedIn, Twitter, Instagram, Facebook, and you can reach us at our email doha@imachapter.org for any inquiries about our seminars and about our performance and anything related to the CMA certificate and also the IMA Doha Chapter. Let me introduce our speakers for tonight. Zacharias Petrus is the founding member and CEO of Audit and Governance Services CC in South Africa in 1998. He has more than 30 years of experience in auditing and related consulting. He has multi-certifications such as CIA, CCSA, CA, and CIMA. And his career includes lots of years of experience in many organizations, 20 years as a CEO of Audit and Governance Services, a successful consultancy that advises heads of internal audit on audit strategy and practical implementation of the IIA standards. He also served with Deloitte for 2 years as corporate governance and internal audit expert, and 1 year as the World Bank consultant in the Bank of Ghana. Also, he served 4 years as Deputy Inspector General of the South African Reserve Bank. Zach is a regular speaker, and he has been invited by many conferences locally in South Africa and also internationally. He was invited to speak in many countries in Africa, as well as Asia and the Middle East, including Qatar, and also New Zealand and Australia. Please put your hands together to welcome Mr. Zacharias Roux.
Good day, ladies and gentlemen. It's nice to be back in Qatar. I haven't been here for about 5 years. And also thank you very much to Mr. Asham and also your chapter for inviting me here. I know him from the internal auditing side, but it's always great to speak to a couple of management accountants also. I said to him just before we started, a long time ago, I was also on the board of the chapter in South Africa for CIMA, which is the UK version of the management accounting side. What I thought would be interesting for you tonight is just maybe a little bit of a different view on the philosophy really that deals with financial accounting and financial reporting. We have seen many collapses really in the financial arena globally with the global financial crisis in 2008 and before that Enron and WorldCom and the like. And it looks like every 7 to 10 years we've got another one of those problems. Then everybody sues the external auditors and they try to address some of the issues like what we had with the Sarbanes-Oxley Act and so on. But there remains a disconnect, and that's what I want to talk to you about tonight. Let me just see, the time is now 20 past. My intention is to speak for about an hour. We'll see how it goes. Maybe I can shorten it a bit to like 45 minutes and we can have a bit of a discussion if that is possible. Let's see how things go. All right. I think the first problem that we have is that this is so often the case that what you see in the accounts coming back from the chief executives and the like would be something like this. I swear that my company's accounts are accurate, and I've checked this with my auditors and directors. But if you read it between the lines, it goes a little bit more like this, right? And those things in brackets are what is worrying. Okay. To the best of my knowledge, which is pretty poor and may be revised, right? My company's accounts are more or less accurate. And I've checked this with my auditors and directors who I pay to agree with me. It's a little bit of tongue-in-cheek, but you can see what the main problem is. There's a lack of trust by the investing public and also other stakeholders when they look at the annual reports of big organizations. And I think the view that we have, and this comes from The Economist, right? It was something that was presented in one of the magazines. And I think that kind of illustrates a bit the problems that we have. Now, we're dealing with a lot of accountants. Let's see if you can do this. I'm going to play a short video. How many of you have seen this video, by the way? Of the ball passing. Okay. Now let's see. Okay. Don't give the answer away to people, but I'm going to run a short video clip and I want you to count. There's going to be 2 balls, right? And they're going to be passed around. But the players in white only passes balls to the players in white. So I want you to count how many times the ball passes between white players in white only, right? All right, how many times was that? 16. Okay, how many of you saw the gorilla? Okay, especially people that have seen it before, they would have seen the gorilla, right? Okay, what else did you notice? How many players do we have? Okay, did you see the player leave the field? Okay, what else did you see? What color is the curtain there? All right, let's go back again. We're going to restart this thing. What color is the curtain, right? How many people do we have? All right. There's a lot of things that are happening, and if you don't focus on it, you totally miss it. And this is unfortunately that happens also. People focus on the financial things, and then they miss a lot of things, right? Okay, this is where the gorilla comes in, right? Okay. All right. So the point of this video is there's a lot of things that are happening that we're not really aware of. They happen in the background. And because we have focused our eyes and our attention on one thing, we typically miss some really big details, right? Like a gorilla walking across the stage, something like that. And the typical problems that I see with financial accounting and financial reporting fall into three categories, and then I've got a kind of broader fourth one, which I also will discuss a little bit later on. But the first issue is that the reports, the financial reports, don't really give us an insight about the risk that the organization is taking in order to achieve their objectives. When I started off my career as an accountant and as a manager, I remember we used to say that the way that you manage is by making sure that you are managing by objectives. Do you remember this? Like in the 80s? Management by objectives was a big issue. And then in the 90s we realized, but there's another aspect that we should also consider. We can't just say, here are 10 objectives for you to go and achieve, and then we don't talk about the resources required to achieve those. And then we started saying, no, it has to be a two-way discussion. So I want you to achieve these 10 objectives, but I also want you to then accept that you can do it within a certain amount of budget and resources. And that becomes a contract, the performance contract, right? So we move from management by objectives with really just one dimension into one that has two dimensions. But in the noughties, you calculate the return on investment. What is the return on investment for company B? Sorry, I flashed it on the screen already, right? Okay, that's 30%. So what's the return on investment for company A? I'm speaking to accountants here, right? Return on investment for company A, how much is that? No, it's not 12%, no. Ah, there we go. Well done. Okay, give the guy extra credits, eh? All right. It's 120%. Isn't that right? Remember, this 12, the 12 over here, who does it belong to? Does it belong to the bank? No, the bank already received 18, right? You're not going to pay them twice. So the bank already received their part of their return. That's why we don't have 30 at the bottom, only 12, right? So this 12 belongs to the shareholders, and the shareholders are only 10. So 12 divided by 10 times 100 gives you 120%, right? Okay. I'm getting worried about you guys now. Okay. So which one is better? Where would you rather invest? Company A, right? You get 4 times more return for the same investment of 10 million. Now let's go through the kind of logic here. Why is that? Why can you with the same 10 million get a higher return in company A? Because of what? Yeah, but because of the gearing, right? Okay, now let's go and see which of these things would be decisions by management. Can you decide to be like company A versus company B, or does it just happen? No, it's a decision, right? So you can decide how much share capital you have to put out, right? You can decide whether you want to take out a loan or not. You can decide even to fix the loan, although it might cost you a lot of money. You can decide what to buy with the money, right? Can you decide what is the return on your assets? No. That one is a little bit more difficult. There's a lot of things that influences that from outside. There could be a new competitor coming on, right? Or there's a change in the global financial economy. Or there could be a change in fashion. Or there's a tsunami or something, and then that will change. Now, if that 30% changes, what happens to the return on investments? Now, I'm going to change it from 30 to 10. This is the Excel spreadsheet, so it's going to go quickly, right? So what's going to happen is, if that changes from 30 to 10, then it becomes 10 and 1. Minus 18 gives you, now it looks like this. So which one is better now? Now B is better than A, right? Okay. Because of the gearing, there's huge volatility on the return. So it went from plus 120 to minus 80. That's a 200% change. Well, if you're not highly geared, the 20% change on a return on assets only produces a 20% change in the return. So that's a risk and reward thing for you, all right? Now here comes the problem with financial reporting. Many organizations run their business like Company A for 360 days of the year. And then just before year end, they sell 90% of the assets. This can happen quite easier in banking. That's why you have more regulation, right? You sell assets with a repurchase agreement and you pay back the loan 5 days before year end, right? So what happens now is you get the benefit of being highly geared, but the balance sheet doesn't reflect it. So the balance sheet looks like that, but the income statement looks like this. And this generates a lot of problems, of course, because this is called window dressing, right? Maybe you didn't see my CV, but I was a chief financial officer of the Mint in South Africa before I decided to go into the auditing side, right? But yes, this is typically what chief financial officers do, is they make sure that the balance sheet looks right for that very specific day in the year, that very important day, right? Now, the auditors can come and audit this. It's true. They can send out bank confirmation letters to the bank. How much does our company owe you? And the bank would say, on what date? And then you would say, on that very specific day. They say, on that day, you didn't owe us anything. Everything was just repaid 3 days ago, right? So you can audit this. This is not that the auditors are wrong. This is really what the balance sheet and income statement looks like. Now, if you are Company B, and you've been running your organization very conservatively and risk averse for the whole year, your board is going to look at you and say, our balance sheet looks the same as the other guys' balance sheet, but they get 120% return. You only give us 30% return. Why? Okay. And they're going to look at you strange and say, but you know, and you can't really pick it up. You can see that there's interest paid. Okay, that part I have to say. Typically on the balance sheet side, you can see that there's interest that has been paid. But these things are also been hidden in strange ways, right? So you can see the problem on this, right? I hope so. That's one problem. Okay, the second problem is the value of the companies. The thinking has been something like this, that we've got an auction situation on the stock exchanges, and the stock exchanges, the price of big organizations would depend on how well they perform. So if we look at their annual financial statements, we can see how well they perform, and based on that we will value the organizations, and that will then bring us an indication of what the value is on the stock exchange and how much we should pay for the share. And this is based on this whole idea of the balance between supply and demand. Okay, most of you guys have studied this thing, right? Where there's a equilibrium that happens, and if the price is too low, then too many people would like to buy it, and the price would go up. And if the price is too high, too many competitors will enter the market, right? Okay, that's the principle there. That principle, does it work for us today? Do we still value things like this? If you buy a cell phone, Do you buy the cheapest one? Or do you buy two for the price of one? If you buy shoes, do you buy the cheapest ones? Or a motor vehicle? Does supply and demand really drive your buying decision? And should it, right? And I would argue we've kind of moved on. And a lot of what we are seeing in the new order, in the sense that where we talk about corporate governance and social responsibility, right? And things like this, where you've heard of the triple bottom line, have you? Anybody? Triple bottom line, how many of you have heard of this? Okay, how many of you have not heard of it? Okay, well, there's a move a little bit about saying we shouldn't just look at one bottom line. We should also look at the environmental bottom line, and we should also look at the social responsibility bottom line before we make our buying decisions. So a big business and a lot of organizations and a lot of countries are signing off on these different treaties based on protecting the environment, like the Paris Accord, right? You guys remember, the whole debacle about Donald Trump not wanting to sign it off because it says it's unfair and the like, okay? Which I guess it is. But the point is this, how can you compete in, say, a modern country? How can you compete against China if you, by legislation, have to pay a minimum wage of $20 a day? Your product is just going to be too expensive and it's going to be priced out of the market, right? With supply and demand kind of issues, right? How are you going to be able to compete against China or Indonesia or places like this if you've got very strict environmental protection laws and you have to buy very expensive filters and you have to buy very expensive effluent treatment plants? Well, in other countries they don't. Okay? They're going to save a lot of money, right? So how can you compete against people like this? So there's a global movement that says when you purchase, and when countries even have business with one another, one shouldn't just look at the price. We should also look at the other two aspects. By the way, I didn't intend to talk about the triple bottom line much, but generally speaking, people talk about the 3 Ps. Profit, which is the economical one. Planet, which is the environmental one. And people, which is the social responsibility one. So you shouldn't be buying from people using slaves, right? Remember quite some time back, Nike was caught out using 7-year-old Pakistani kids to stitch up the Nike shoes, right? And what happened to them? They were punished by the stakeholders. Their share price dropped tremendously. People stopped buying Nike shoes because they didn't want to, step on sweatshops. And Reeboks, I think, became the #1 running shoe for a while because of that. So what I'm trying to say with this is, a lot of organizations, when you look at their value, it is no longer based on just an economical decision. It's based on other kind of aspects that comes into the decision, okay? And international treaties and the like. Okay, if you look at the balance sheet and income statement of the following different kind of organizations, how representative is the capitalization of, say, Apple to their balance sheet? It's almost like a disconnect, isn't it? Same with Google, and same with many of these big brands that we see up there. If you look at their balance sheets and income statements, does that indicate what the price is for their share price? So why should investors then look at the balance sheet and income statements at all if it's not driving the share price? Do you see what I'm saying? We're living in a strange world, where these things are disconnected. 50 years ago, share valuation was very straightforward. You looked at the past 5 years worth of performance and you projected that into the future. And if it's not a going concern, you look at the net asset value as an indication of the price, right? Now it's very different. Okay, my own country has a big company that was in the news for all the wrong reasons a little while ago, a place called Steinhoff. They were listed also in the German stock exchange. And they had window dressing and were caught out. And by the way, Deloitte was there. Is our investment safe? They want to know this, right? Now let me illustrate some of the problems that we have typically. Let's say there's a big organization. Their profit, their bottom line is $1 billion under CEO number one. And the CEO number one is now getting tired. You can see it slipping a bit, right? And they decide it's time for a new blood, some new CEO to come into the organization. And they appoint a new chap. And this new person says, listen, I can make a lot of money for you. I think I can turn this place around. From 1 billion bottom line, I can take it higher. But what's in it for me, right? Why would I work so hard and sacrifice my family time, to make money for you if there's nothing really in it for me? So you negotiate something like share options, or you negotiate some kind of bonus or something like this. And if you read up on Nassim Taleb's kind of issues, he says that's part of the problem. They only have upside. They don't have really downside risk. They share when the price goes up, but they don't share when the price goes down. But let's say, just for argument's sake, they've negotiated with the board has negotiated with the CEO, that if he turns it around, anything more than 1 billion, he can get 1% of that as a bonus. Okay, does it sound fair? All right. Now this person can turn it around quite relatively easily. The bottom line is something like this. You've got turnover of 20 billion and you've got expenses of 19 billion, and that's why you've got a bottom line of 1 billion. So the new CEO looks at this and he realizes, if I want to make money, I can either increase the turnover or I have to decrease the expenses, right? Which one do you think is easier? Yeah, it's easier to decrease the expenses, right? So which expenses would you target? Yeah. Okay, you look at the big numbers, but there's typically two things that you look at. The first one is you want to have non-disclosable figures, right? Non-disclosable items. And most of the items are non-disclosable, if you think about it, except for things like audit fees and depreciation and so on, right? So it must be non-disclosable. The second thing is, if I only have a 2-year contract, and then maybe renewable for another 2 years, if I reduce the expense, I don't want it to have an immediate effect on the turnover. It has to have a lagging effect. And most things have a lagging effect. So the things that comes to mind would be this, things like repairs and maintenance. If you cut repairs and maintenance, what happens with the turnover? Nothing. What happens with profit? It goes up. Yeah. Okay. What about marketing? If you cut back marketing, what's going to happen with the turnover in the next year? Not much. Not much, right? The awareness is still in the market. There's a lagging effect. What about research and development? If we cut back on that one. If you look at the pharmaceutical industry, they spend a lot of money on research and development that only maybe 1%, 2% of that actually makes a lot of money for them after 10 years, right? So if we cut back on research and development, what about cutting back on exploration? Cutting back on training? You can cut back a lot, right? So out of the 19 billion expenses, let's say we cut back just 1 billion. What happens? You double your profit. What's the bonus you get? 1%? Maybe I should ask you guys again. What's the calculation? 1% of 1 billion is how much? 10 million, right? It's not a bad bonus. So this guy's got another year to go, and now he really has to go for it, right? Okay, he really cuts back in a big way. Even to the extent where he kind of sells off some of the assets with leaseback agreements and things like this. Okay, just to generate more cash. Okay, so at the end of 2 years, the board now says, okay, we have to review your contract. And they say, you've done very well for us, thank you very much. We would like to extend the contract for another 2 years. So what's this person going to say? So normally the CEO would, at the board meeting, say something like this: in pursuit of new challenges, or for personal and family commitment reasons, I've decided not to renew the contract. At this point, this person is the hero of everybody. The shareholders, everybody loves them because the share price went up, because the profit went up and everything went up. Okay? Now, the question is this: did this person commit fraud? No. It's really like this, right? Would the external auditors qualify the annual report? No. The money is there. You can go and count it. It's in the bank. He really saved all that money, right? Because there was just too much fat in it, right? Okay? So everything looks up. This is not the person that goes to jail. Who goes to jail? The next guy coming in, right? Okay? So now there's an interview. We've got a CEO number 3 in line. He now wants to take over from CEO number 2. Now imagine this. If you come in as CEO number 3 and there's an interview, you say to them, listen, if you appoint me, I will make sure that next year we will make a loss. Are you going to get the job? No. In order for you to land the job, what do you have to promise? You have to promise this, right? As a minimum. And they're going to say, are you going to be able to stand in the shoes of CEO number 2? He was on the front page of Finance Week last month, right? Okay? They say, I'm going to try, right? So when you get appointed as CEO number 3, and you start realizing, but wait a bit, the turnover is now falling down. The machinery is breaking down. People are leaving. We are losing market share. We've got all these kind of problems, right? If you do the right thing, all the so-called savings over the past 2 years, you have to go and reinvest in those things. You're going to have to reinvest in marketing. You're going to have to reinvest in your people. You're going to have to reinvest in maintenance, right? And what's going to happen with profit? You see, I'm giving it a little bit of a scoop at the end there just to give you some hope, right? Okay? So it might be able to turn it around, most probably not in a year, most probably not in 2 years. But if you are the CEO and you try to do the right thing, what is going to happen at the first board meeting, you think? After 3 months, they're going to ask you, are we still on track for the 5 billion you promised for this year? And you're going to have to say what? No, I don't think we're going to make that. As a matter of fact, I think we're going to make a loss. What? This company hasn't made a loss for 150 years. Okay, and as a matter of fact, we were on a winning streak, and now you want to make a loss. What's wrong with you? Not only that, you promised us 5 billion, right? He says, yes, but you know, the previous CEO caused a lot of problems. Say, no, the previous CEO made us a lot of money. Don't blame this person if he can't fill his shoes, right? Do you see the problem here? Where were the auditors? Well, the auditors would say, well, when we were there, that was the amount of money they made. And we can prove it. We counted the money, it was in the bank. Well, or it was given as dividends to the shareholders or something like that, right? But you can prove the money was there. This caused a huge panic. It's not the first time that we see this kind of problem. This problem we've seen often. This is almost the exact story of Enron, by the way. The only difference is CEO number 2 didn't resign, he just stayed on, right? Okay, but that's the very typical story that we have every 7 or 8 years. We have the same problem. This thing kind of reoccurs all the time. Something is wrong. Okay? And if you look at the reaction on Enron was Sarbanes-Oxley. But Sarbanes-Oxley didn't prevent Lehman Brothers from going down. It didn't prevent AIG from having huge problems, or, some of the motor companies, I wouldn't mention them. All right? There were a lot of problems out there. And every 7 years we seem to have this. Now, I remember in the 80s, you can see I'm a bit older than some of you, but I remember in the 80s when I tried to get a loan for my first house. The interest rates were very high in the 80s. Why? There was the savings and loans problem. I don't know if you remember the savings and loans debacle, where a lot of banks started to go bankrupt. And when there was an investigation, the first indication was the banks went bankrupt because they relied on fraudulent financial statements in order to extend loans to big corporations and small corporations and medium-sized corporations. And there was a crisis in the auditing profession. And the whole system had a bit of a shock. And there was a commission of inquiry in the US called the Treadway Commission, and there was a Treadway Commission's report issued a long time ago, 1987. Okay? Anyone remember the Treadway Commission's report? Have you heard of COSO, by the way? Committee of Sponsoring Organizations of the Treadway Commission's report, right? So COSO is still the de facto best internal control and risk management framework out there. But it was based on the Treadway Commission's report. And the Treadway Commission's report said something like this. It says, and this is a shock to auditors and accountants, it says organizations do not go bankrupt because of inaccurate financial reporting. Okay? Organizations do not go bankrupt because of inaccurate financial reporting. As a matter of fact, they have inaccurate financial reporting and even fraudulent reporting in order to cover up for the fact that they have been bankrupt for 2 years. Okay? So it's a cause and effect thing. Organizations do not go bankrupt because of inaccurate financial reporting. They have inaccurate financial reporting because they are bankrupt. And that is why you had all these frameworks coming out, including the COSO framework. COSO stands for Committee of Sponsoring Organizations of the Treadway Commission's report. And some of the sponsoring organizations was the IMA. Okay, and the CPAs and the Institute of Internal Auditors, and quite a few, I think there were about 6 sponsoring organizations that they pooled money and they put out to tender to find out what can we do about this thing. Okay? And the Treadway Commission's report essentially said we need better internal control, but we don't know what it is. What is better internal control? So let's go and find out. So the sponsoring organizations pooled the money, put it out to tender, and Coopers and Lybrand got the tender to find out what is internal control. And they brought out the first COSO report. In 2004, it was revisited again, and it was PwC that did the revisit. Of course, Coopers and Lybrand became PwC, right? And then this is still being updated. Every now and again you will see there's some update on this. The short answer I will come to a little bit later on, but the focus needs to shift about just looking at historical information and then projecting the historical information. There's a bit of a problem with trying to do that. A lot of work has been done by risk managers. And essentially what they are saying is this: in order to get more assurances that your investment is safe, you need to know where the management and the board has taken seriously their role regarding good governance, good risk management, and good internal control. And they have to sign off on it. They have to sign off that they had good internal control and good risk management and good governance. Now, if we had to get the board to sign off over here that there's good risk management, and we had the CEO signing off that there's good risk management, now we can sue them. Because obviously they didn't do their job on risk management. Because they were taking huge risks by not maintaining plant and equipment. They were taking huge risks by not training their people. They were taking huge risks. You see what I'm saying? So that's the kind of short answer on this matter. But it's not that straightforward, and it's fairly difficult to build this new accountability framework And the auditors are struggling with this. So the way that I typically see it is, we all know that communism kind of died in the 80s, and the icon of communism coming down was the Berlin Wall coming down. That was the kind of view of it. And most of the traditionally communistic countries moved from communism. They kind of moved a little bit, didn't they? They moved towards more capitalism. But then again, we had also problems with capitalism. Okay? With the financial crises and all those kind of things. And I think the icon was Enron. So what I'm suggesting to you is, the way that I can see it now is, I think that most of the traditionally communistic countries like the USSR, East.
Now let's open the floor for questions. Can we have any questions? Thank you, Zach. It was very informative, very waking up. Now let's open the floor for questions. Can we have any questions?
Thank you very much, Zach, for the interesting presentation. I really personally enjoyed it very much.
Thank you.
So you summarized the shortcoming of the financial reporting in 3 parts, which is governance, risk management, and control.
Yes.
So that's contribute to the lack of the shortcoming of financial reporting.
Yes.
I can add to that one in my own perspective, which is my area of research, and it was my PhD as well.
Oh, please.
Which is that I think there is also a lack in the accounting system itself. When they ignore kind of, we call it intellectual capital.
Sorry, say that again?
Intellectual capital or intangible capital and resources, which that actually contributed to the value of the company, the share price, the market value, but does not capture by the accounting system itself.
Can you give us an example?
Yeah. For example, when you have caliber people in the CEO of the company, so that's a human capital, okay? That's not captured by the accounting system, but they actually contributing to the success of the company, then to the value of the company itself by the share price, the market value, okay? So that part, in my opinion, so contributed to the lack of the financial reporting. You reporting something, you say this is reality, but the market, when they value the company itself, they pay more, and they're willing to pay more. For example, par value of the share is $10, but they're paying $100. The net book value of the company is $1 million, but they're willing to pay $20 million, for example. So why is that gap and does not capture by the financial reporting? And that's why you say it's become less and less relevance,
Yes.
less and less outdated. We can say, you don't tell me the building is 10 million when it's in reality is 100 million. The land is 5 million when it's in reality is maybe 200 million, something like that.
Yes. Yes.
So that's why I see, in my opinion, there is a gap in the accounting system itself.
Yes.
The fundamental of the accounting, by ignoring certain capital, intangible resources, and capital, that does not capture by this accounting system due to, in my opinion, one does not meeting the criteria of recognition, then you cannot measure it, then you cannot report it. So what we need to do to go to this shortcoming of financial reporting is just we have to find mechanism to report those intangible, or what we call it, intellectual capital, that's really contribute to the value of the company, to the share price as well. Okay?
Yes, yes.
So how are we going to go to that one? We need to change the fundamentals, because we were stuck on the idea of does not meet the criteria of recognition, we cannot measure it, then we go back and chicken or egg, then we come back again and again. So that's, in my opinion, just something like adding to the main 3 areas. So yes, then we do have good corporate governance. You we should have a very good management, risk management system and internal control. That's why I agree with you 200%.
Yes.
So thank you very much.
Thank you for that contribution. Yes, and that's absolutely right. I think the problem is, and quite rightly said, is how do you measure these things? Like, for example, reputational risk. How do you quantify your reputation? How do you quantify things like your brand name? How do you quantify the competency of your people? How do you quantify ethics in the organization and the culture of the organization? All those things have a bearing on the share price and on the value of the organization, but it is not transparent to the people buying the shares. How do you communicate this? This is a big problem. I remember when I started off as an internal auditor, we used to think that we have to audit the big numbers, you know. So you look at the income statement and you immediately start auditing salaries, okay? And you look at the balance sheet and you immediately start auditing, you know, land and buildings and things like that, because we thought the bigger the number, the bigger the impact on the organization's value. And then we start realizing, you know, there's hard and soft controls. Like, for example, what would you rather have? Would you rather have 4 levels of segregation of duties, or would you rather have ethical people? Okay? It doesn't help to segregate incompatible duties, and the 3 people that do separate functions are 3 members of the same mafia, the same syndicate, right? They're going to override the thing. Or what would you rather have? 3 levels of authorization or competent people? Because if you have incompetent people signing for things they don't understand, does it really add value? So the next question, of course, then becomes, but what are we auditing? Are we auditing ethics? Are we auditing competency? Are we auditing management style? Or are we auditing segregation of duties and reconciliations, and we count assets and things like this? And that is the challenge. And I think that the challenge is, how do we become transparent and how do we measure these things? Now, I know, for example, we try to say that polluting the air should cost you something. That's why we have carbon credits and the like, right? So that we try to put a value on, say, the environment. So if you hurt the environment, it has to cost you a certain amount. And you can pay it for by spending it on somebody else that is saving the environment. Okay? And therefore, the supply and demand will channel the money to where people are saving the environment and things like that. But it becomes really difficult when we start dealing with some of these other issues like reputation and ethics and management style and things like this. Thank you for the contribution. Anybody else? Yes.
Are we not moving from the rule-based accounting to the...
Can we have a microphone? Thank you. There we go.
Are we not moving in order to overcome these shortcomings from the rule-based accounting to the principle-based accounting, and going towards the integrated reporting, which is going to be the future reporting, taking from the IFRS and all those things. So, how far we will progress on that?
Yeah, that's a good observation. What I see is rules-based accounting. And even rules-based governance. There's kind of 2 thoughts about it. I think in the Commonwealth and in Western Europe and so on, principle-based is big. But in America, we want to sue people. And you can't sue them based on breaking principles. You have to sue them based on breaking rules. Okay? So, in big corporations, especially American corporations, rules-based is still, I think, the thing that carries the day. If you think of the Sarbanes-Oxley Act, that's a rules-based reaction to Enron. Okay? In other places we said, no, we have to make sure that there's judgment calls. Okay? And we need to talk about what is the judgment and the principles involved. And of course, we can't codify everything, because then the book just becomes so big that it becomes impossible to deal with. I think part of the solution is that we need to be more technology driven. And I think it's possible where there's much more transparency that can happen by big organizations, not just to their shoulders, but to the wider stakeholders, people that need to breathe the air that they are polluting. They need to be able to click on that company and say, how much are they polluting the air? And therefore, responsible people will no longer buy their product. Responsible people will no longer invest in their organization, right? And that's the kind of penalty that will happen because of this. It was found in places like Canada and so on, when the rules changed about having to publish the certain chemicals, and I think it was 95 different chemicals that you had to publish that you are putting into the atmosphere. Ever so suddenly, the companies, just because they have to now make the transparent to everybody, they self-controlled themselves. They cut their own emissions just because they were shamed into doing so.
You a small token of appreciation.
Thank you very much. Thank you. Thank you so much. That's very kind of you.
Thank you.
Lovely. Thank you very much.
This is our seminar for tonight. After the event, we are going to send the survey of the event, so please share with us your thoughts, anything you think that we can enhance for the future. And please, you can enjoy the break, which is set outside. And we are planning to have another event in November, so stay tuned and follow us on our social media and also through your emails. We are going to send the certificates of attendance for you through the emails that you registered in the Eventbrite. But keep willing to receive it within the coming week to allow us to send the certificates to everyone. Thank you so much for coming and have a good evening.